What I'm about to tell you right now might be one of the most important financial warnings you hear this year, and I need you to treat it that way. For the next few minutes, block out everything around you, ignore the notifications, stop scrolling, and focus only on this voice, because this is not just another investing video filled with basic advice or recycled tips. This is about something much bigger, something that is quietly building beneath the surface of the economy, something most people are completely ignoring right now, and something that could directly impact your money, your savings, your investments, and your future. The scary part is not that a financial shift might happen. The scary part is that when it happens, most people won't be ready. And when people are not ready in the financial markets, they don't just lose small amounts. They lose years of hard work, years of savings, and sometimes opportunities that never come back. Right now, everything looks normal on the surface. The stock market still moves. People are still investing. Social media is full of success stories, and everyone seems confident. But if you look deeper, if you actually pay attention to the signals that experienced investors watch, you start to see a completely different picture forming. A picture that doesn't look stable at all. A picture that looks familiar in a very dangerous way. If you go back in time and study major financial crashes, whether it's the 2008 financial crisis or even the rapid market collapse in 2020, you will notice something very interesting. The signs were always there before the crash happened. Not hidden, not secret, but visible. The problem was never the lack of information. The problem was that people ignored the information. They believed things would continue going up forever. They trusted the momentum. They followed the crowd. And when the reality hit, it hit fast. That is exactly how wealth disappears. Not slowly, not gradually, but suddenly. And right now, we are starting to see similar patterns again. Markets in certain sectors are overvalued, speculation is rising, and a large number of new investors are entering without fully understanding risk management, portfolio allocation, or long-term strategy. At the same time, inflation has already affected purchasing power. Interest rates have changed the cost of borrowing, and global economic uncertainty is still present. These are not random factors. These are pressure points. And when pressure builds in a financial system, something eventually breaks. Now here's where it gets even more serious. Smart money is not waiting to find out what happens next. Institutional investors, hedge funds, and experienced market participants are already adjusting their strategies. They are reducing risk exposure, reallocating assets, increasing liquidity, and preparing for volatility. But you won't see this clearly on social media. You won't see influencers talking about reducing risk during hype cycles, because that doesn't get attention. What gets attention is excitement, fast money, quick profits. But real wealth is not built on hype. It is built on preparation, discipline, and understanding timing. And this creates a dangerous gap between what experienced investors are doing and what the average person believes is happening. While one group prepares quietly, the other group continues to take risks without realizing the environment has changed. Let me ask you something. If the market suddenly drops 20%, 30%, or even more, what would you do? Would you stay calm and follow a strategy? Or would you panic and start making emotional decisions? Because that moment, that exact moment when prices fall and uncertainty rises, is where most people lose control. They sell at the worst possible time. They exit positions at a loss, and they promise themselves they will re-enter later, but later never comes. At the same opportunity, this is not a theory. This is behavior that has repeated itself over and over again in every major downturn. And the reason is simple. People prepare for profits, but they don't prepare for losses. They think about how much they can make, but they don't think about how much they can lose or how they will react under pressure. This is why what you do right now matters more than what you do during a crash. Preparation always beats reaction, and preparation starts with understanding your current position. Do you actually know where your money is invested? Do you understand the risk level of your portfolio? Are you heavily concentrated in a single asset class, or are you diversified across multiple investments like stocks, index funds, ETFs, and defensive assets, because diversification is not just a buzzword. It is one of the most powerful tools to reduce risk during uncertain market conditions. When one sector falls, another may hold or even rise. That balance is what protects your capital. Another critical factor is liquidity. In simple terms, cash. Most people underestimate the power of having cash during volatile markets. They think being fully invested all the time is the smartest move. But experienced investors know that cash is not just idle money. It is opportunity. When markets crash, assets go on sale. High-quality companies, strong index funds, and valuable investments become available at discounted prices. But only those who have liquidity can take advantage of it. Everyone else is stuck watching or, worse, forced to sell their investments to cover expenses or losses. That is how wealth transfers from the unprepared to the prepared. Now, let's talk about something that is quietly influencing everything right now: interest rates and monetary policy. When central banks increase interest rates, borrowing becomes more expensive. This affects businesses, reduces expansion, slows down economic activity, and eventually impacts corporate earnings. And when earnings slow down, stock prices adjust. This is a chain reaction, and it doesn't happen overnight. But when it unfolds, it affects the entire market. If you are investing without understanding this, you are not investing, you are guessing. And guessing in financial markets is one of the fastest ways to lose money. But here is the part most people don't expect to hear. A market crash is not just a threat. It is also one of the biggest opportunities you will ever get. Yes, it creates fear. Yes, it creates uncertainty. But it also creates price inefficiencies. It allows disciplined investors to buy valuable assets at lower prices and build long-term wealth faster than during stable periods. The problem is, when fear is at its peak, logic disappears for most people. And that is why only a small percentage of investors actually benefit from crashes while the majority struggles. So, instead of focusing on predicting whether a crash will or will not happen in 2026, shift your focus to something far more important. Ask yourself if you are prepared for either scenario. If the market continues to grow, are you positioned to benefit? And if the market declines sharply, are you protected enough to survive and strong enough to take advantage of it? Because the truth is, no one can consistently predict exact market movements, but everyone can build a strategy that works across different conditions. If you start now, if you review your investments, reduce unnecessary risk, build an emergency fund, focus on long-term fundamentals, and avoid emotional decisions, you put yourself in a completely different category of investors. You move from reactive to proactive, from uncertain to prepared, and that shift alone can change your entire financial future. Because at the end of the day, markets will always move, crashes will always happen at some point, but the outcome for you depends entirely on one thing: whether you were ready or not. And right now, at this exact moment, you still have time to prepare. The only question is, will you take action now, or will you wait until it's too late?